This conference will now be recorded.
Okay, now we're into module 12, and we're going to be building off of modules 10 and 11, or maybe just more expanding into that. We're still going to be using the same type of revenue and expenses coming in, but now we're going to measure it and how it's different used as a rental properties or vacation homes. So when we start off here, there's one big difference between rental and business. When you talk about rental properties, they are considered passive income. So there's three types of income. Your own business, and then working in a normal job as an employee would be an active wage. Then you get your portfolio income. Gains and losses in stocks is one of the most common. And then your passive income, and real estate falls in that area. Now with passive, typically you cannot have a net loss. If you do, you can't take it against other types of income, the active or portfolio. You can only take the losses against each other. So if you have two rental properties, one was an income and one was a loss, then you could offset those. Otherwise, you could not have, say, a negative $4,000 on your tax return for your rental property, because then you would be taking that $4,000 against regular income. Now, there are two big exceptions. The first one is if your rental activities are considered your primary job. If they are, then you would actually list these not as a Schedule E, but on Schedule C. And to be considered professional in a real estate business, meaning that is your primary income, that is your primary job, you have to meet these two criteria. As long as that takes up more than 50% of your time in your working hours, and you have worked at least 750 hours that year in the rental real estate business, and you'd have to be able to document that. So that's exception number one. If you meet this rule, then you're considered as a traditional business, Schedule C, and then you can deduct as much loss as you have because it's considered active income. Part two, okay, now you're just a regular landlord and you don't do this for your full-time job. You have to file Schedule C, but you are allowed to take some deductions. And you're allowed to deduct, this is a pretty high number, up to $25,000 in losses, subject to the phase-out rules, and we'll see that here in just a minute, as long as you actively participate in the management. And so what I mean by actively participating is you don't have to be doing stuff all the time on a regular involvement. All you have to be involved is in decision making. You actually approve the tenants. It's not run by some outside agency. You own it, but then some company runs your rental for you. That would not be considered an active enrollment. Then you do not get to this $25,000 option on a loss. And the other weird one here is, do you own at least 10% of the interest? You probably own it all. Okay, so you do get to take a loss in either one of those cases, and in this case, this is just for your normal renter, and as long as they approve the renters, collect the rent, direct who does the repairs, they don't have to be doing things every day in the business to be counted as a regular active participant. Okay, so for the phase out, you can take the up to 25,000 in losses a year if your MAGI, that stands for modified adjusted gross income, and it's modified because what they do is they add, if you'd had any IRA deductions in your adjusted gross income, they add that back. They take off any Social Security benefits that you may have added in, but then they add back any interest you took off as an education loan. Remember, all of these are on Schedule 1, except the Social Security benefits, and then any other losses from rentals. So that's why it's called a modified adjusted gross income, because there's a few things you got to tweak. But as long as you're under 100,000, you're fine. If you're between 100 and 150,000, you can take some of the 25,000, just not all of it. Over 150,000, you can't take any of it. And so how it's done is the 25,000 is reduced 50% of whatever you exceed the lower limit. Okay, so what that means is if you are at 110,000, you're 10,000 over the lower limit. So therefore, half of that 10,000, you would have to take 5,000 off of the 25, and then you could only deduct up to $20,000. That's how that works. We can do one more. Let's say you're at 130,000 MAGI. You're 30,000 over, so 50% of that is 15,000. You have to take 15,000 off of this, leaving you only 10,000 left. So you could take a loss of up to $10,000. Okay. All right, let's try some examples. We have this retired taxpayer. So basically meaning this is not their full-time job. They just do it on the side. Looks like they have one rental. They collect $500 a month. They had a pretty rough year and had a lot of expenses to upkeep on the house. Have just a modest MAGI, not over any caps. And I want us to be able to tell what is the realized and the recognized gain or loss. And what I mean by realized and recognized. Realized means if you were just doing this without any special tax laws, just accounting 101 style, what would be the total loss allowed? And then using any tax law stipulations, how much can they actually take on their tax return? So take a few minutes here, pause the video, and then we'll go through the answer. Okay, so with this one, we had monthly rental income. If this is $500 per month, so that would be $6,000 per year. 6,000 minus the 10 says we had a net loss. We had a realized loss of $4,000. That would be what's called our realized, because that's what we just calculated, bare bones, no rules. And then this person would actually qualify for up to the 25,000 loss rule. So they could record this and recognize it as a 4,000 loss on their tax return. They could put a negative 4,000 for Schedule E. Towards the end of this lecture today, we're going to look at a tax return and do an example, and you'll see where Schedule E actually appears on the tax return. All right, this number 2, the only difference is the expenses went way up. Now this is not, probably would never happen. I can't imagine a scenario where you'd have 40,000 in expenses. Perhaps maybe with a lawsuit you could, but 40,000, if you put on a new roof and do things like that, those are considered capital expenditures, and you actually have to add those into the house and depreciate them over the life. So you can include things like that. So 40,000 may be a bit extreme, but this is just for our example purposes to see how the phase, or to see how the losses are limited. So go ahead and pause and then see what you get for the realized loss and then what's actually allowed on the return. Okay, so for this second one, the realized loss is really high, $34,000. Now for tax rules, we can't take any more than 25,000 if this is just a regular type of a rental property. So the most I could take is 25,000 here as a recognized loss. The rest of it is considered a passive loss, and I can only offset that against other passive income. All right, our last example. With this example, the biggest difference here is the modified adjusted gross income. So look through this one and see what you get when you have the phase out limits. Okay, so we have 6,000 again for our income minus the 17,000 in expenses. So we're left with $11,000 in losses. Now, if this taxpayer was under the 100,000, they could take all 11 because you're allowed up to 25,000. But we do reach the phase out. So out of the 11,000 that is considered realized, we have to figure out the phase out. All right, so the 130, remember you take the difference between that and the lower where the phase out starts is 100,000. The difference is $30,000, and then you take 50% of that 30. So that means we can only that's 15,000, and then we can only take 25 minus the 15. The most I can possibly take as a loss is the $10,000 that's left out of the phase out. So again, you take your main allowable amount as a deduction. You're allowed to take up to 25,000, but then we had the phase out that said, okay, 30,000 is how much I'm over the cap. 50% of that I have to take off of my 25,000 starting point. So I'm only allowed 10,000. That would be what's considered my recognized loss. Anything else would be a passive loss that has to offset other passive income. Okay, so the key rules there, remembering the $25,000 limit, and then that there are phase out rules involved as well. Just some things to keep in mind later on. All right, with rental income and expenses, we're going to do these on Schedule C. I'll bring up a Schedule E, I should say. I'm going to bring up Schedule E in a few more minutes, and we're going to see how it works in our tax software. So things that you can deduct for your rental properties, some of the biggest items, your real estate taxes and mortgage interest that you may still be paying on your rental property. And then any insurance you have, repairs, depreciation, you can take all of those type of deductions. And then you can also take travel to get to and from your rental properties, especially when you're doing repairs or collecting rent or anything associated with the rental property. You can include those travel. You typically would do your standard mileage rate. So recording all of your trips, that's going to be key. All right, how the IRS says you have to allocate your expenses, you have to do them in a certain order. First, and this is going to come into play more when we get to the second half of this lecture, when we look at vacation homes, which is coming up shortly. With the vacation homes, we're going to begin to allocate some things. We're going to begin to allocate our mortgage interest in real estate. But with rental property, most of the time rental properties are 100%. They're 100% rented by somebody else. You don't use it any for yourself. So therefore, we take these expenses in this order. So your mortgage interest and real estate taxes and all your other normal expenses to keep the property going. Maybe you have to pay a plumber to come in and do something. That's fine. That's an expense. All your normal round trip mileage is fine. And then finally, you take depreciation. Depreciation has to be done last. And then note here, I put this little side note here. We got to separate out our furniture and any other appliances, because when you do it like that, you can deduct your depreciation much faster. You're not allowed Section 179 for any real estate assets, so therefore you can't depreciate it real quickly all at once like you could with a business. But when you separate out your furniture and other assets, you can depreciate those within 7 years. Whereas the actual home and the roof and different things in the garage, maybe if it's a separate structure, you have to depreciate those over 27.5 years. You don't want to have to depreciate your furniture over 27.5 years. It's not going to be there that long. So that's why they allow you to depreciate that. You can separate those items specifically out of the house value and do those separate compared to the actual structure. Any major costs, like I had mentioned before, when you update the home, you put on a new roof, you add on a garage, a portable garage perhaps, you put in new items that are going to be there a while, you've got to capitalize these and you can't expense them right away. So things like flooring and carpeting, you can count those as separate. You can count those as these other furniture and appliances. But things that are going to last a long time, your driveway and fence, those are going to be actually more landscaping or perhaps added into the value of the home, like the garage. Okay, now the difference between a rental property and then what's considered a vacation home. A vacation home can be separated into 3 different areas, where the vacation home is primarily you are the only one that uses it. You rent it out very seldom. The second one is your vacation home. You use it very seldomly, but you do occasionally, but you rent it out most of the time. And then the third one is just a mix. You use it and you have it rented out on your behalf. So we're going to look at the specifics for each of these and how they're done for tax purposes. So if it's primarily personal, the key here is there's only one rule. You use it, or excuse me, you rent it out fewer than 15 days per year. That's it. It's a real simple rule. You rent it out less than 15 days a year, look what happens. This is one of the rare times that in tax you could get income and it not be taxable. Because they're saying if you rent it out 11 days and you collect income, they're going to not even consider that as rental, and therefore that's just tax-free income. That's a great deal. However, the only downside is any expenses you may have when you rent it out. Maybe they damage something, you can't deduct that, or any other fees that may go along with having it rented out. With it being primarily personal, it would be considered your second home, and you could still deduct mortgage interest and real estate taxes on your primary return on your Schedule A. So that is 2 areas that you can deduct, and you'd be able to deduct everything, all mortgage interest and all real estate taxes paid. All right, when it's primarily rental, so notice the definitions here: rented out 15 or more days, and now this is where you have an option. It's personal is not more than 14 or 10% of the days rented, whichever is greater. Okay, personal purposes for not more than 14 days or 10% of the days it's rented. So I gave a little example here. If I happen to rent it for 210 days and I use it for personal purposes of 19, that's still okay. It still falls under this rule, because even though I use it more than 14 days, it's not more than 21 days, 10% of this. So therefore it is considered primarily rental. And then whereas on this one, just the opposite, if I rent it 50 days and I use it personal 11, you say, okay, 10% of the rented days is only 5, but I get to do whatever's greater, 14 days in this case, or 10% of 5 days rented. So this would still be considered a primarily rental because I was under that 14 mark, or not more than 14 and under. Notice here how, which is a little different than up here, you can't take any expenses and then you're allowed to use all your mortgage interest and real estate taxes. Doesn't matter if it's rented 10 days or 5 days. Here it does matter. Any expenses you put on your return, they have to be divided out between personal and rental days. This is known as the Irs method, and we're going to look at a different method in just a few more minutes. But the Irs method is very simple. Total rental days, so say we rented it 50 days, just like in this problem up here, out of total days home is used. So total days home is used is 61 days, the 50 plus the 11 that I used it. So that's how I would separate out my expenses. 50 divided by 61 would give us a percentage, 50 divided by 61. So any expenses that I have, 81.9% would go as rental expenses, and I could use that as a deduction. The other 19% I could not use as a deduction because those would be considered personal expenses. With this one, if it's primarily rental, it's considered kind of like a Schedule C, and you are allowed to take a loss. I shouldn't say Schedule C. It's like a Schedule E with a regular rental property, and you are allowed to take a loss if you meet those phase out guidelines. And as well as you are an active participant in the management. All right, the third option, the final option, if you don't fit in one of the first two, you're going to fit in this one. So the property is rented 15 or more days, and you use it for more than 14 days, or 10% of the days rented, whatever is greater. Okay, so you fall in between. The same as number two, your expenses are allocated, just like they were above using the IRS method. The only difference here is if you have a loss, you cannot take it as a deduction because you're using it so much for personal purposes. The losses are disallowed. Now, the one I had set up here using the IRS method, there is one exception to where you don't have to use the IRS method, and you can use what's called the tax court method. The tax court method is only allowed for these two items: mortgage interest and your real estate taxes. And the reason for those two are because those two are specifically allowed as both personal and rental. Because for personal, you can take those as a Schedule A deduction when you itemize. Okay, so the reason that this is allowed, or let's first how the tax court is different. They take it based on number of days rented. That's the same as the IRS method. But instead of dividing by number of days used, they divide it by the entire year. So it's a much smaller percentage that you use on Schedule E. But then it's a much greater percentage that you can use as a Schedule A. So if you need help getting your Schedule A up to be able to itemize, or perhaps these numbers are really high, meaning you cannot take any depreciation because you've already hit zero and you can't take a loss, then you could take less of your mortgage interest and real estate taxes, move those to Schedule A, and take more for the depreciation. The only time that you would ever even consider using the tax court method, you have to have both of these conditions met. You're not going to find this in the book. This is things that I have came up with through practice that has to be there. Otherwise, it just makes no sense to use the tax court method because it would be a wash. You're going to come up the same if you switch numbers around. Let me give you an example here. So with the both conditions, meaning if the taxpayer must itemize. If the taxpayer doesn't itemize, then it does no good to move these to Schedule A if you're not going to itemize anyway. You might as well keep them all on. You might as well keep as much as you can on Schedule E, where you can take a deduction. So it does no good to use the tax court method if you don't itemize, or you won't if maybe you're just on the cusp, and with that extra amount of mortgage interest in real estate, you would be able to itemize. Then it's okay. You met condition one. Condition two is using the IRS method. You have net income that would be at zero. You have more expenses than you do revenue coming in, then it would be a good point to go ahead and do the tax court method because you're probably going to save. Even when you use the tax court method, note with this item here, the tax court method is only for the mortgage interest and the real estate taxes. All other expenses still must use the IRS method. And you have to count your expenses in the same order as we did rental. Therefore, this is where it becomes important that your mortgage interest and real estate taxes are done first. So if you are at net income of zero because you use so much up here in these guys, you would want to be able to reduce this amount on Schedule E, move that amount to Schedule A, and then be able to use more of the depreciation, which you wouldn't have gotten to use otherwise. Travel expenses are 100% deductible if you are working on your vacation home, as long as it is no personal use when you're actually at the vacation home. So if you go and work on your vacation home and you are working on it every single day for a majority of the day, then you could deduct 100% of your travel down to your vacation home. Otherwise, you would have to do it on a, like you do on a business trip, and prorate it 60% versus maybe 40% personal. You could deduct 60%. Management fees, you are allowed those as 100% deduction. That's one of the odd ones. Most of the other, like if you repair something in your vacation home and you use it 60% rental, 40% personal, you can only deduct 60%. But management fees are considered one of the exclusions, and you can deduct all 100%. Okay, we're going to look at, to finish up this lecture, it's a pretty short lecture, but these questions will take a little longer and more time to actually work through. And then we're going to actually look at number 4 after we finish this one on paper. We're going to see how it's done on the tax return. So the key things here, we rented our home 200 days, used it for personal 50 days. So we need to decide which one is it, primarily personal, rental, or is it a combo? And then I give us the income and then our different type of items that I spent money on. And you have to go through and decide which ones are allowed as a deduction, which ones aren't. And then deciding, all right, using the IRS method, how much, what would be my net income? And then is it worthwhile to use the tax court method? And let's assume that this person does itemize. So what I want you to do is go through and figure out what would this individual's net income be. So basically you can't just take all the depreciation or all of the maintenance. Remember, you have to do it on a percentage basis. Do it the IRS method, and then we'll do the tax court method and see what the difference is, and then bring that to the tax return. So take you about 5 minutes or so and go and work through this one. Okay, so with this example, this one is considered the third option, a combo between rental and personal. So what we have to do is, first, what I would do is go through and show that the first 5 items on here are actual expenses that I can use on the tax return. These latter 2, I would have to include into the value of the home and then depreciate it accordingly, and that number would eventually end up affecting my depreciation balance. So these 2 I do not get to deduct. These 2 are going to be added into the value of the home. So with the rest of these, what I have to do is take the number of days rented, 200, and divide it by the number of days used total, because this is, we're going to do the IRS method first. So that's 200 divided by 250, and that comes out to 80%. So every one of the expenses I can list as 80%. Here we go. Oh, let me do the IRS method first. All right, well, what I've done here, I'll go through both. It's going to be too hard for me to show it either way. But with this one, let's look at the IRS method first over here. You can take 80% of 6,500. So if you take, because that was our mortgage interest, so 6,500 at 80% is the 5,200. And then subtracting out our real estate taxes at 80%. So if I take 14,000 minus the 5,200 minus the 2,800, as you can see, I'm left with net income of still a positive 6,000. For the utilities, I can take 80% of 2,500. So that would be the 2,000, same as the tax court, no changes here. Both of these have to use the IRS method. 80% of 1,000 is 800. So 6,000 minus 2,000 minus 800, that leaves me left with $3,200. And then 80% of 5,000 depreciation would be 4,000, but I can't take 4,000 because I'm limited by my net income. I can only take 3,200. So that means I'm wasting $800 of depreciation. So even when I take the 3,200, I'm down to a net income of 0. Now let's look at it how it's the other way using the tax court method. The tax court method, everything's the same except these two lines. And notice we're taking less mortgage interest on the Schedule E. We're taking less real estate taxes. And the reason it's less is because my denominator is a bigger number. Instead of 200 divided by 250 for this one over here, 200 divided by the entire year, 365. So 14,000 minus these two amounts gives me net income left of 8,520 compared to the 6,000. So I have an extra 2,520 I can potentially use as more allowable expenses. Same amount of deductions for both sides down here. We can't change anything. So when I take the 8,520 minus these two, I'm left with 5,720. And then of the depreciation, it was 5,000. I can take 80%. So I can take the full 4,000. Now you might think, wait a minute. Right now I've got an income that's actually have a balance. I'm going to have to pay taxes on that, whereas over here I wouldn't have to. That's true. But we've got to look at it even further. The amounts that I saved up here that I didn't take, that I otherwise could have, that I did over here. So basically the difference between these two numbers, the amount that I did not take, I can take it on Schedule A. Okay, so, all right, I have an extra 1,720. If this person did not itemize, that's why I had rule number 1 up there, when to use the tax court method. If this person doesn't itemize, it is not a good idea to use the tax court method. If I don't itemize, I want to use as much as I can, get me down to 0. I don't want to have to pay tax on $1,700. But if I do itemize, as I said this person does, look at what happens. There's an extra 2,520 that I couldn't take or that I didn't take up above. And remember that number, that 2,520. That was the difference here. And you could have done that adding these, subtracting out these two. You could have done it on a piece by piece basis and said, okay, the difference between 5,200 and this is a certain amount. And the difference between this and this is another certain amount, and add those two together and you're going to get 2,520. Or you could just look at what's the difference between my two net incomes at this point. That's how much I did not use in real estate in mortgage interest using the tax court method. So that's how much I can bring down and use on Schedule A. So even though I had income here that I have to pay tax on, I'm saving on my taxable income 2,520 on Schedule A. So yeah, my Schedule E went up by 1,700, but my Schedule A had more of a deduction of 2,500. So therefore, netted those two combined, I did end up saving taxable income. I have $800 less in taxable income than I would have if I would have done the IRS method and then just used the smaller amounts on Schedule A. I know it seems a little confusing, but it's just like on Schedule A. I'm going to real quickly go through the difference here. So the difference between the 5,200 and the 3,562, I got to use an extra 52 minus 3,562. I got to use an extra 1,638. If I would have done the IRS method, I would have only been allowed to use the 6,500 minus what I used for real estate tax purpose. Yeah, for my real estate vacation home. I could only use 1,300 on Schedule A. Whereas with the tax court method, I could use 6,500 less the 3562 because I used less on my Schedule E. So therefore, instead of it being 1,300 on Schedule A for mortgage interest, I can use 2,938. That's a pretty big difference. That's 1,638 difference that I can add to my Schedule A. All right, with that, before we look at our final two, I want to look at the tax return. So I'm going to pull up a practice return, and I call it Joe Practice. And I have some beginning numbers in here. So we're going to look at the 1040. For my Joe Practice example, I put in just a modest or just a W-2 income, not too high, not too low, $40,000, and took out and have a little bit of federal income tax taken out and a few different things, some state taxes as well, of course. Notice with my practice example here, I made just enough in itemized deductions for this to take effect. Because if you don't itemize, then there's no reason to even do the tax court method calculation. So in my little example, yep, we do and have enough to itemize. It's not, I mean, I can go in and show you what they were, but it's not important to know. Just to know that we do have enough to itemize. Now what we're going to do is I'll tentatively just kind of want to remember this 459 number. I'm going to write that down off to the side. 459 is my initial refund. And then what we're going to do is look at where our Schedule E stuff goes. So Schedule E will eventually end up here in your total income amount from Schedule 1, and it'll end up here in line 6. But Schedule 1, where it is right here, your rental real estate. We're going to go here to line 17. And I've already got a real basic one started. Got my Joe Practice. And we're going to assume that this is a vacation property. This is our vacation home, so it is important that we notate it as such, that it's a vacation property. And in my example, on that example we just did, for personal use, remember it was 50 days and rented out at 200 days. So initially I'm going to put in those figures. And then let's put in the rest of the amounts that we had. Let's pull it back up. I had income of 14,000. So other rental income, I'm going to put that in here as 14,000. Now we're going to come down into the expenses and see how these are looked at. So let's do the utilities. That's one that comes up pretty fast here. Utilities, 2,500. Here's utilities. We put it in here in the actual, and then notice what it does in the allowed. It takes it by that 80%. So what we had already done on paper, it does it automatically for us here. The 80% is what's allowed. Okay, let's put in our remainder. Let's put in, we got maintenance of 1,000. Notice I'm holding off on the depreciation just for a second. Maintenance of repairs of 1,000. So 80%, that looks good. Real estate taxes of 3,500. Okay, so we got our taxes here, 3,500. And then finally we had the mortgage interest of 6,500. So those were the only items I had. Now we can put in the depreciation. Notice this here is depletion. We don't want to do depletion. We want to actually do the home. Now this is going to be the only part that's going to be, I'm not going to be able to do an actual amount, but this is what you would do. Because to get to the actual 5,000, I'm going to have to kind of guess on the amount of depreciation. So this will be the only one that's a little off. So let's put our vacation home, date and service. Oh, we'll say we put it in, we're back in 2011, just make up a date. And I'm going to call this rental property. Notice there's a difference here. Rental property, furniture, and fixtures actually has a life of 5. I had said 7 earlier, but life of 5 years, which makes even more sense. And then the residential rental property, you'll notice that changes to 27.5, so much, much higher. Now let's just pretend, let's see what it is if I put it our basis of our property at 200,000. So I'm going to scroll down here. All right, current depreciation is 72. So let's make it a little bit less than 200,000. Let's see what 150 does. Let's see if we can get close to that 5,000 mark. That's pretty close, 5,400. Let's try to get it just a tad closer. Let's do 142. That's even closer. Let's finalize it here at 138. Let's see if that gets us real close. Yep, that's real close, $5,018. So that's real close to my example. That's what I wanted. Okay, so we're going to go back now to the Schedule E and see how that was fit in. So there you can see the 5,000 taking 80%, but remember 80% would have been $4,000. So the program knows that I can't go more than that. So remember on our example using the Irs method, we had to cap it at 3,200. So when we added up all of our expenses, 14,000, we had income of 14,000, therefore net income of 0. But even with I had a net income of 0, look what happened to my refund. My refund actually went up. It went from $459 to $699. And let's see the reason why. The reason why was because of my Schedule A. The program knew that if I didn't get to use my real estate taxes and my mortgage interest, then they would push the rest of it to my Schedule A. So my Schedule A actually went up. I don't know if you remember the difference or not, but it used to be $13,100. Now let's go in and look at the two areas, the interest and the real estate taxes, and see the new number that's added. So I've got my W-2 amounts, that was fine, that was already there. My previous real estate taxes. Here's my new vacation home taxes of $700. If I go back to my answers, remember of the real estate tax, there was $700 here that I didn't get to use on my Schedule E, the difference. It knows that $700 then would go to my Schedule A. Same thing here. If I go back to my worksheet, my actual writing it out, there was $1,300 that I didn't use because only $5,200 could go to the Irs method. So therefore, the extra $1,300 was added into my interest. So the higher itemized deductions meant I get a higher refund, less taxes. Now, the final thing, let's see how we would do this if we did the tax court method. So the tax court method says that the mortgage interest and the taxes can be different. What we have to do is, it's a real hard to find, it's right here. Vacation home limits. You're going to click on this and on that little folder, and it's going to say, okay, how would your numbers change? And you actually have to do these calculations on your own. So what amount should your home mortgage interest be? If it's not $5,200, well, we had calculated it. So we're not going to use the $5,200. We're going to use instead $3,562. So $3,562 is going to be our new amount. Now off to the side, we'll want to jot down that difference. Remember on our mortgage interest, it was at $1,300 that I was allowed to use. Now, the difference between the $5,200 minus the $3,562, how much I took off, I'm going to add an additional $1,638 to my original $1,300 that was on my Schedule A. Okay, that's step one. That's changing the mortgage interest. The real estate taxes, it doesn't have a nice place for me to change it, unfortunately. So I have to do it here. And I have to do it as a big no-no but this is one of the few times that I allow you to do an override. So we're going to have to override, and instead of 2800, it should be 1918. So 1918 would be the amount I put in here. Okay, so remember before on my real estate taxes, it did have a 700 on there on the Schedule A. It had the $700 difference. Now we're going to tack on even more of a difference. We're going to tack on an additional amount. So when it's all said and done, I need my mortgage interest to read like this. I need it to be 6,500 less 3,562, how much I was using on the tax court method. So my mortgage interest better be 2938. We're going to go check that on the Schedule A. My real estate taxes on Schedule A should be 3,500 less than 1918, and that is 1582. All right, so our final step using the tax court method, I've changed it here in my Schedule E. So if I go back to my Schedule E, notice the amounts, it is changed, it's 3,562. My taxes have changed, and then therefore the amount of depreciation has changed. Remember, it was at 3,200, and I actually now have income. But we're going to go now to Schedule A because there's something we're going to have to fix. The tax software is good, but it's not great. If you wrote down the numbers as we were doing it, the vacation home worksheet adjusted just fine, just as it should have. It's now at 1582. Great. However, notice here the vacation home worksheet didn't adjust. It's an error in the program. So we need to go in, and this is the other time that you have to override. So override the field. Instead of 1,300, it should have been 2938. And then look what that does to my overall refund. I was around it was like 670 or 690. Now by using the tax court method, just changing a few numbers around, I'm now up to an 801 refund. So a quick little preview of what you're going to be doing inside the tax return. Again, you may want to rewind this and go back through it a couple times because it can be confusing initially. And as you walk through the shoebox problem, I outline exactly which ones you need to override as well, so you won't forget. All right, let's do the final two problems. Example 5, seeing how things are different, and then how in example 6, how things are a little bit different. All right, so in example 5, we've rented the house 50 days, personal 25 days, so a much smaller percentage thing instead of the 200 and 250. I got my income and expenses here, what can be used, what can't be used, you have to decide. And then using the tax court method if we need to. And we're going to assume again that this person does itemize. So take, now that you kind of know how to do this, take 5-10 minutes and see what you get on example 5 using both methods. All right, let's go through the answers. So using the Irs method, I got 50 divided by 75 days rented. So 66.67% would be my the amount that I'm going to use as a percentage basis. Let's go through the answers. And I did it both ways. Let's bring this down so we can see it all on one screen. All right, so we got 6,000. The Irs method, I'm going to take the 66.67% times the 4,100, and that's what I would have got. Then the same percentage times the real estate tax, 1,500 total. That's what we get. So we take the 6,000 minus these two. We're down to only having income of $22.67. Whereas over here, my income is much, much higher because I used days rented divided by the full 365. So 6,000 minus my mortgage interest that I'm using minus the real estate tax. Utilities and maintenance are going to be the same no matter which one I use because I have to use the IRS method. Notice the only thing I'm not using is the AC system. That would be a major improvement in the house. I cannot deduct that. I have to add that in and depreciate that with the house. So I take the 800 minus our starting figures on both sides to get how much net income I have left. I normally would be able to deduct $26.67 when you take 4,000 times 6.67%. But over here, I'm again limited. So I could only take 1,000, leaving me with income of 0, which is great. But then I'm not able to use a whole bunch of depreciation like I wanted to. Most of it is eaten up here in things that I could have been using on Schedule A. Here, yeah, I have a net income, but when it averages out, it works out okay. Because even though I have more income in my Schedule E, I have a lot more deductions that I can take on Schedule A. An extra $21.71 and an extra $7.95 that I wouldn't have gotten to use otherwise. And that $21.71, how I got that is I took the difference from what I was using to what I am using now with the tax court method. So that's an extra $21.71 that I'm getting to use that I wouldn't have otherwise. So a net savings here, what I'm saving minus the additional income, I still do save money, the extra $16.67. And that's what that difference is here, the extra depreciation that I'm taking, $16.67 an extra. So that's a good thing to do. All right, on our last example, this one won't take you very long, or at least it shouldn't. Assume the same tax info above, except that the house is rented only 12 days and personal use 100 days. What is the income and loss that can be claimed with this vacation home? So think about this for a few minutes and then I'll give you the answer. All right, with this one, the key is this one's primarily personal. It's rented for less than 15 days. So therefore, we don't have to record any of the income, but we don't claim any expenses either. So 0 income, 0 loss, all of the real estate and mortgage interest would go to our Schedule A. With that, we are wrapping up our Schedule E in module number 12, doing rental income.